Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 285 for December 28th, 2020. We are recording this at 1 p.m. Eastern Time. My name is David Kosmeter. I'm the creator of TimingResearch.com, and I have here the option professor. So you should be seeing his screen right now, and this will be a solo episode with him, and he's going to give you his forecast for 2021. So I'm going to go ahead and turn it over to him.
Okay, and welcome everybody. Good to have you with us. This is optionprofessor.com, and I am going to be going over many opinions and observations that we have going into 2021. So I'm going to be going over a lot of information. If you have a pen and paper there to take notes, you'll be able to take some notes on what we're seeing, what we are believing, and what our opinions are going into the new year, and what we're observing. And it's going to go over different sectors of the stock market. It's going to go over different fixed income, and it's going to go over different things like currencies, Bitcoin, and stuff like that. So we've got an hour to cover it, and there's an awful lot to cover. So let's take a look at what's going on. First of all, we know today what happened was they passed the stimulus. Trump signed off on the stimulus. So that looks like $300 more a week, I guess, going out to people. And then, of course, other stimulus going out with the PPP, et cetera. So again, one thing we have to remember, though, is this package is about half the size of the one we had back in April. And one could argue that the situation is even more serious than it was back then. So we didn't have the vaccine back then. So again, it'll be interesting to see how things play out. We've had a big jump here this morning on the opening. And then, like I say, let's see where they take it home at the end of the day. But bigger picture is what we're talking about here today. And I'm going to show you charts and moving averages that are going to be long-term, like 20-year, and then shorter term, 1 or 2 years or 5 years, and then a relatively shorter term. Well, let's do the three, the 20, the 5, and the 1 to give you some perspective. So, because we are talking about the next 3-6 months, what it looks like, the trends look like. Okay. All right. Again, a little background on myself. I'm a graduate of Boston College. I've been doing this for decades, and I've done, many hundreds and hundreds of seminars on the options and educated thousands of people nationwide and in Canada. So the bottom line here is that I do have product knowledge on this stuff, and I've been in the business for quite a long time. So again, we feel like we're qualified to give you opinion and give you some observations, and then of course, take it for what it's worth. Okay, let's start out with the aggressive growth, and this is the stuff that we were talking about back in March and April. Okay, March, April. This was the ones we talked about then. So the first one obviously would be tech. And I'm going to be using some Vanguard ETFs, but you could use any ETF you'd like generally with this stuff. So on VGT, which is the information technology over at Vanguard, you get stocks like Apple and Microsoft. They got many, many stocks. I'm just citing a few. They got Apple, Microsoft, PayPal, NVIDIA, Salesforce, Cisco, all types of information technology. And you can see that on a 20-year basis, this thing is very, very bullish, but it's also very, very extended. And our theory is that this extension is going to have a correction as people, and when interest rates rise, I think it has a more of a negative effect on this type of sector. And so we could see a correction through compression of valuations. And we could see a correction simply because, using your common sense, it's extremely far away from its moving averages. Let's turn it a little closer to the 5-year. And again, the reason we were saying this back in March and April, can you see in April, this is the crash, right? And then once it gets back above the blue line, that's your green light. So once it gets above the blue line, you're buying it and keeping it and buying it and keeping it, and you put your stop underneath the blue line and you're riding it up. Now, on this one here, it's trading at 355, and the long-term average is down here at 300. So is there a lot of real estate between there and there? There is. And you can see the high being made here on information technology is not really being confirmed by the RSI. RSI here was 76 during the last high. Now we've made a new high, and the RSI is at 69. That's not a huge divergence, but that is a divergence. Okay, that could indicate that the volume's drying up, and that we are extended to a point where things could reverse, or at least correct. The 1 year, there you go again. Let's see what we got here. Again, you're not making any big new highs on the RSI, and you're looking at a situation again where it got violated here during the correction back in, I guess, in September, when a lot of stocks topped on the FANG and stuff like that. They topped in September. Still haven't taken out those highs. They may, but they haven't so far. And then here you go, your 1 year moving average long term is down at 336. So you still got some real estate there going on as well. But clearly an uptrend. And if you want to keep it on the shortest leash possibly, the short term moving average there, the 12 SMA is at 347. So as long as you stay above 347 on a short term basis, or you want to give it a little more room, staying above 341 would be something that would be worthwhile. Okay, but again, this is something we talked about back in April and March. That's when it was the best deal. Now it's not quite the deal, right? All right, let's turn over to the next big runner, which is consumer discretionary. People are at home. They can't spend money on travel. They can't spend money on going out to eat. They're getting checks in the mail from time to time, and they're going out and spending it at Home Depot, and they're spending it at Walmart, and they're spending it at Target, right? And they're buying stuff, clothes, and they're buying, furniture, and they're buying, stuff, Whirlpool, stuff. So the bottom line here is we'll take this back 20 years, and you can see, again, this was one of the ones we talked about back in April. Once it got above this line, which was in May, okay, and actually when it got back in April, that's when it first broke, came back and tested it in May, that was your buy signal, okay? And then you're riding it up, and you're using these averages to stay with the game. Now, is it extended? Of course it's extended. And let's see if the RSI is making new highs. Not too much. The high here had, the high right there, had an RSI of 71, and the current RSI is at 72. So not much of a new high on the RSI compared to the price. Looking at it on a 5-year basis. Now, in the consumer discretionary, the stocks involved there are many, but some of them include Amazon, Home Depot, Tesla, Nike, things you have a choice to spend money on or not. Starbucks, Bookings.com, TJ Maxx. So bottom line is that, again, still looks very, very strong. And will animal spirits just take it straight up? It's possible. But again, that RSI looks very muted compared to the price action. And when the RSI looks muted compared to the price action, and you're that far away from the averages, it's not the worst thing to use some caution. And that's why we've been suggesting people look at rotating into value and dividend payers, which has been not a bad deal. So anyway, consumer discretionary here on a 1-year basis. You want to keep it on a short leash. The short leash would be at about 266. A moderate leash at 260, and longer term comes in at 260 as well. Let's see. Yeah, the short-term one's at 270, then 266, and then 260. And that's the consumer discretionary. Again, the first three that I've showed you are the first ones that I've showed you are the faster movers. We give you another one, which is the communications, telecom communications. Everyone going crazy for the 5G. So obviously that's why this particular one has done very well. And looking at it on a long-term basis, put it in perspective, this is going back 20 years. It's the highest price it's ever been, and that's pretty darn far away from its moving average. RSI is going a little bit higher, but certainly nothing in conjunction with this kind of action. So again, you have to be a little bit concerned that we are overbought here, and some people are looking for, Tom Lee of Fundstrat was saying he is looking for a move. He even used a number of 35.50 or so on the S&P, which would shock a lot of people. But when you look at this graph, and if it pulled back, would you really be shocked? Not really. So bottom line here is that's what it looks like on a 20-year basis. On a 5-year basis, still very overextended. Now, what's in the communication sector? Things like Google, Facebook, Disney, Netflix, T-Mobile, Activision. So, the ones that people are using, with communication. I'm sure other communication stocks might include Qualcomm and Broadcom, which have also had big runs. So those are another couple stocks that are in that thing. What are you looking at here? That's what you're looking at on a 5-year basis. Okay. And then if you're looking at on a 1-year basis, you want to keep it on a short leash. That green line looks like a pretty good one to keep it on, which would be 117. And clearly the blue line, which hasn't been broken since November, since we had that drop, back in that end of the third quarter. There you go. It comes in at 60. What's it coming at? 115.96. So again, if it takes that out, it should, and it's really strong, it should continue. But if it doesn't, you have to have some kind of a defensive mechanism in there if you're trying to control the risk a little bit by, having an exit strategy. Okay, the next, so those are the ones that have had big runs. One last one I'll get to here is mega cap growth. And in mega cap growth, let's take a look at it. Now, in mega cap growth, you're going to get things like, again, similar ones: Facebook, Apple, Google, Amazon, Tesla, NVIDIA, the ones that are really moving. And obviously, again, all of the ones I just talked about, we were keen on back in April. Can you see? That's where you got your buy signals. This is all riding the train back up, all riding the train. Did they have you jump off the train a little bit? Yeah. But if you bought down here, you might have been able to give it a little time. Even if you got out after it broke and got back in here, you're certainly not doing badly. So again, the trend looks still pretty good. Let's go back to the 20-year so you get the overbought condition historically here. Now, again, a lot of this is a product of negative yields. You're comparing valuations right now to negative yields, to low interest rates. But the negative yield means that some of these rates may change. And if rates change, then your valuations may change on a lot of the stuff that I'm talking about here. And if they change, you could see earnings come in, but then a compression of the PE ratio, and the stock could either be flat or go down simply because of valuation compression. Okay, so there you go. You're up there at 203, and you can see it's in rarefied air, and you can see their RSI is dead. I mean, that's a dead RSI compared to this action. Look at all this action here. That's a dead RSI. So this is the stuff that I would be concerned about trimming or doing something with, hedging with call options, meaning covered call writing, or doing collars where you sell the call, buy the put. At the end of the broadcast, if you have questions, optionprofessor@gmail.com is where you could submit them. But anyway, because I can't go over everything in an hour. But I can give you some broad views here. And the broad view is we're very extended on a lot of the mega growth stuff. And let's just see what the RSI looks like on the 5-year here. Yeah, that's a dead RSI compared to where you are. In this kind of situation, you would either see a parabolic move, and then this RSI would go nuts again, or you're going to see some type of petering out and some type of backing and filling. Right now, it seems to me, since most of the news is out of the bag, we've got the vaccine news, you've got the stimulus news, you got the new president news, and so, the news is pretty much there. So anybody who wanted to act on those news, you have to say to yourself, maybe they've already done it. But we'll see. Because again, in this kind of formation, you can go parabolic and just get further away from these averages. But you can see on a historical basis, it is very, very overdone here. And of course, that has a lot to do with interest rates being very low. And again, people being able to demand a much higher valuation than normal. I mean, we were at 15-to-1 PE on Apple. Now it's what, 30, something like that? More? Okay. All right. So now here's the ones that we thought might have some potential for next year that, as you can see all these ones that have blown out their former highs and have gone way up here. Okay. That's what happened to growth. They blew out their highs and they're way above their highs. Just to give you an idea here. This is January. Okay. So this is beginning of the year. All right, that was the high on this particular one, mega cap growth. Can you see how much higher it's gone from last year's highs? I mean, that's enormous. Okay. All right, so now let's look at ones that are moving lately, but are certainly not in the same kind of technical setup. And we'll start out with the industrials. Now, industrials include things like Honeywell, Union Pacific Railroad, UPS, Boeing, Raytheon, Caterpillar, Lockheed Martin, just to give you a few names. Okay, now you can see on a 20-year basis that they just made a new high by a little bit. So they're not nearly as extended as the other, and that's on a 20-year basis. Okay, and we started getting involved with this as far as suggesting people focus on it back in more like May and June. So you'll see here on a 5-year graph again, May and June, when it started to get going like this, that was when we were interested. And then, of course, it was above the red line, which was pointing straight up. So that wasn't a bad parameter to use. Once it broke above the red line here, it was way down here. But getting above all three of them is always key. So it got above all three, and then the green line gave you a nice little stop loss to use on the way up. And right now that comes in at 144 with the market at 169. So again, this also could pull back. It might pull back to fill in that gap, and it might pull back to the breakout point of 160. But if it did that, that might be a heck of a nice area to accumulate. Again, the RSI on these markets is not really confirming this huge move, and that's concerning for technicians, I think. Okay, so that's your industrials. Again, what we'd suggest here is pullbacks to 155, 160 might be, where's the average at? It's at 153. So 155 to 160, and then a worst case scenario, you wouldn't want it to be much under 145. But these trends look good, and they're not that far above their long-term highs. Again, this is last year's high, and they just took it out, as opposed to growth, which is way past it. Okay, next one is going to be materials. And in materials, you're looking at Freeport-McMoRan, Newmont Mining, DuPont, Sherwin-Williams, materials, and many other stocks as well. Now, again, this is another one on a 20-year basis that has just took out its high and not that far above. So, and all the moving averages are coming in here and converging at around 125 to 130. So that's your neighborhood of major support. And then basically any kind of a pullback towards 140, 145 or something like that, would be worthwhile to take a look at, because again, these things are not nearly as extended as growth. And remember, some of these also pay decent dividends. So, getting 2%, 3% of a dividend while you're watching a movie that's appreciating is not the worst place to be. And of course, if you're in these very, very extended markets like Zoom or whatever, and the things change, there's significant volatility of principal happening. Okay, so there's your materials. Now let's look at mega cap value. Now, mega cap value would be Berkshire Hathaway, Johnson & Johnson, JP Morgan, United Healthcare, Disney, Walmart, Verizon. These are some of the names, many names, but these are some of the names. And in this one here, you haven't even taken out the high yet. Okay, so there's the former high on the 20-year basis from January. That comes in at 88 and change. You're still trading 85. All the averages are converging here. So you would imagine there's decent support between 75 and 80. And so there could be an opportunity here. And again, this pays, these stocks pay dividends while you're waiting. So again, you can see they have a good history of going up over time. They did get whacked like everybody else, but now they're back on the bicycle like everybody else. But they're not on the bicycle 5 miles ahead of the pack. And that's what makes them interesting. Okay, now we've got what they call high yield, not high yield, high dividend stocks in a portfolio. And again, I'm using these as examples only. You could look at any one you like, but this is the direction I'm focused here. We're focused. Okay, so anyway, you've got VYM here, again, hasn't taken out its high. The high has been 95. And then basically you're looking at 90 now. And now you are looking at the moving averages all coming in between 80 and 85. And the RSI is in a positive mode. And again, the RSI above 50, in our view, is a positive. That's when things can go up. I mean, that's why I like to see the RSI above 50. You notice this thing's going up the whole time, and where's the RSI? Well, here's your 50 number. It's above 50 pretty much the entire time. So being above 50 is a good deal. And then having the moving average rising is also a good deal. And that's why these things may do a little more work here. But again, taking out 95 there looks like a reasonable expectation in 2021. And again, this thing is over 3% dividend. So that's not a bad yield while you're watching the movie. Then you got an international high dividend. And that's interesting because it includes stocks like Novartis, Taiwan Semiconductor, Toyota, Royal Dutch Shell, Siemens, Bank of Canada, just to name a few. There's many, many stocks in these ETFs, as you know. I'm just trying to give you a flavor. And this is relatively new, so the history is not that much. So let's go back more towards the 5-year graph and see if that gives us a better picture. Yeah. So you can see last year's high, or this, where are we at? January here is right here. Hasn't taken out there yet. Okay. The averages look like they're turning. So it's reasonable expectation, because of the moving averages pointing up, that the momentum of the stock or the ETF is rising. Again, the companies seem to be the ones that will benefit from the coming out trade. People will probably, do more with some of these companies once the vaccine is disseminated. And of course, a lot of the international has to do with Asia, which is, waiting for us to come back. And then we are looking at Europe, which, they've got their problems right now as well. So bottom line is once those problems are more resolved, that's probably when you get more appreciation if things pan out that way. Of course, that's our opinion and that's our observation and that's the direction we're thinking. Okay, so that gives you, and that pays over 3% as well, dividend, I believe. So that's something else right there. In addition to that on the value front, let us also look at mid caps. This is mid-cap value. And mid-cap value on a 20-year basis, let's take a look. Again, it has a decent history to it. Past performance, not indicative of future results, of course, but it does have an ability to rise when economies are improving from 2009 to 2019, right? Has a decent flow there. Got whacked like everybody else, but now it's back on the bicycle, but it's not way above its high. And again, I think this pays over 2% as well, dividend. And of course, dividends are not guaranteed. They could change them, they could reduce them, they could increase them, whatever. But right now, it's paying some cash flow, and that's not terrible. Again, the RSI is above 50, so that's not bad either. Okay, and these could include things like Freeport-McMoRan, Carrier, Eversource, Motorola, Corning, just to name a few names. Most of these ETFs with the mid cap and smaller do have many stocks in it. Next one is going to be on small cap value. Now again, this is the stuff we were talking and having people focus on back in May and June. Okay, so this one here has still not taken out its high. Okay, RSI is 50, above 50, and it's above the moving averages. May do more. It's lovely to see the red line get above the blue line. So I mean, obviously there could be more work to be done, or it could be a deal like back here. Look at what happened back here in 09. Everything looked terrible when it bottomed out. But once it started getting back above the moving averages, particularly above all the moving averages, it was the beginning of something. And we're anticipating that it's the beginning of something here. To give you an idea on what the growth small cap looks like versus value, and this is why people say value may have, I'm trying to illustrate things you hear on TV. Oh, value, growth, value, growth. Well, there's growth. Okay, there's small cap growth. And do you think that's had a big run? Okay. So what people are saying sometimes, and I'm one of them, we're one of them at optionprofessor.com, is that maybe trimming out of some of this and rotating into the value is not the worst thing in the world. Obviously, this has been a great place to be, but it also looks pretty extended. And ergo, trimming some of this and rotating it into the value doesn't seem like a crazy idea. So that gives you a little bit of an idea on all the different sectors of value. There's a couple of other sectors of value that, of course, we think has some merit. Of course, this would be the financials. And we've been very keen on Wells Fargo. We didn't think it's going to zero. So 22 bucks, 24 bucks looked like a pretty good deal. But all of them, booked price to book on Citigroup when it was in the 40s was 85. Very cheap, very cheap. And now it's in the 60s. So the bottom line, same thing here. This thing gave us the signal to go. Pretty much around 65 is when we started getting very keen on it. And but of course, anything after May was a good time to take a look. I'll give you the shorter term thing here. Yeah. So I can see it was a hold, it wasn't paying off. It wasn't paying off, all summer long, just in a range, 56, 62. Once you break above 62 and you're above all three lines and you gap up, there's an old adage, what gaps up goes up and what gaps down goes down. And so that adage certainly worked very well on this one. And that's your financials. And look, there's still plenty of room here. There's the highs up here at 78. You're still trading 72. And like some people say, don't look at these, 52-week highs as the ending, just like you saw in growth. When they make a new 52-week high, they can keep going. And these things, again, a lot of these pay dividends, 2, 3%. I mean, at one point, I think we were getting 4% on Citigroup and buying it at 0.85 to book. There's nothing wrong with that, nothing to be ashamed of there. So the financials also, there's a place in the world for on the value front. And some people think healthcare may also be something to take a look at. Your J&Js, your United Healthcare, Abbott Labs, AbbVie, Medtronic, Pfizer. These are the ones people see in the value frontier. And they're looking at the 20-year graph. I'm sure it's popped to a new high here, but again, not nearly as extended as growth. So the new highs came in here in the 190 area. You're trading 221. So what are you, about 10% over the, little over 10% or so over the thing? If you got pullbacks in healthcare, it looks like it'd be a good place to be. Demographics are good. And, anybody who's been to the doctor knows they charge money, right? All right, let's talk. And of course, a lot of money could be put into healthcare with the Biden administration. So you got a lot of funding going on. That's another reason why materials look good under Biden, because if an infrastructure deal comes in, you're probably going to need a lot of materials. Same thing with the industrials. Okay, so there's a little bit of a backdrop there. Turning towards the last thing on the value front here is in the energy sector. Now here you're talking about stocks like Chevron, Exxon, ConocoPhillips, Kinder Morgan, Schlumberger, Phillips Petroleum. Okay. Now again, we thought that was also a pretty good deal after it bottomed out in earlier this year. I mean, you go minus $37 a barrel in crude. Does that sound like the low? I mean, come on. Go out on the freeway. They're not all electric cars by any means, right? There's hardly any out there actually compared to how many are still gas guzzling. So there is people using this product. It's not like the product's out of business. And when you go down in price to negative 37, there are a lot of people who close up shop, like the frackers, and the rig count goes way down. And OPEC is, trying to make sure they survive, so they're cutting production. And obviously, all that production does not come right back on automatically if they do change the demand. So our feeling has been is that the demand is, people can't fly, so they're not going to just stay in their house like prisoner of Second Avenue. They are going to drive someplace, and that's what they've been doing. So again, right now, because we got cases spiking on the virus and we got hospitalization spiking, obviously there's a concern on demand. And so you've had a sell-off in this. But I don't think the sell-off is permanent. We think very much that there's going to be a rally next year, and it may go closer to where these moving averages are. So this thing here could possibly go up towards 60 to 70. on a best case scenario, maybe up towards 80 if things got hot and people are really out there. If they're really out there, what's going to come back? Jet fuel, right? Jet fuel. What's going to come back? Gasoline. Okay. And, again, these refined products can be very helpful to these companies. So again, that's what it looks like on the long term. Shorter term, how's the 5-year look? The RSI is still above 50, so it's hanging in there. You certainly want this thing trading and staying above 45. Okay, our feeling on crude is as long as it's above 30, everything's cool. 30 to 35, that's your base on crude. You start seeing a 2 number there, a 2 handle, and we got trouble. But again, people are looking for inflation to pick up. People are looking for demand to pick up. And if those two things happen, you are looking at what? You're looking at a good future here in the energy sector. So again, you're above all the moving averages and you'd like to stay above 45. Okay. On a 1-year basis, it's rolled over a bit, I think, but it still hasn't broken the averages. So right now, this thing at 50, you'd certainly like to stay at above 50. RSI is on the ledge too. So if you break 50, it probably will go down and maybe even go into that gap of 40 to 45 if you break 50. If you start breaking 55, looks like it's off to the races again. So I'd keep a close eye on this. And this thing pays like 4 or 5% dividend. And there's plenty of these energy stocks that pay dividend. True story is during the crash in March, I was looking at a 10-year non-callable Occidental Petroleum bond expiring 8/15 of 2029. And it was yielding 35%. Because everybody thought Occidental and everybody was going to go out of business, right? Back in March. So those who stepped up, that's why you get those people, those junk bond guys, those distressed equity guys. That's the kind of stuff they do. They go look into things that look like they're a steal of the century and they take their shot. Well, if you took your shot there at 35% yield, the yield on that thing is now under 5. So just imagine what the price did if the yields went from 35 to about 5. The price of that bond went through the roof. So again, that's a true story on Occidental Petroleum. But even now, compared to what you get on other investments, the yields on the energy sector is quite good. Certainly, you don't want to overload it. But again, if you're a believer that you think that the demand for their products is going to be quite good on the other side of this thing, and you like to get paid a very handsome dividend, although they can cut dividends, But if they don't and they pay, and a lot of them are bent over backwards to try to pay, you're looking at a very good situation here, possibly going up and making new highs over time. Okay. All right. So that gives you a little bit of an idea on some of the different sectors. Again, I've showed you ones that we thought were extended, that maybe you might want to do some trimming or hedging. And then we showed you some that we think have started their ascent, and that as we come on the other side, you could see some significant appreciation. And again, there are many ETFs in these type of sectors. I just cited the Vanguard ones, but that was for an example purpose only. And you can obviously do whatever you'd like. If you have questions on this type of activity, simply shoot us an email, optionprofessor@gmail.com. And if we can give you a hand with our input, our opinion, our observation, then so be it. Obviously, the investor always makes his own decision and always talks to his brokerage firm and his broker about the suitability and appropriateness of any investment. But as far as an opinion or an observation, we're more than happy to share that with you. And obviously, we're hoping that we're giving good information out as best as we can. Okay, let's talk about fixed income. Okay, first thing to look at, TLT. Now, the Fed's supposed to be easy, right? So obviously the whole world is expecting that. Boy, if they ever saw inflation come back and had to be non-easy, just imagine the rock of the world that would be. Because everyone is betting that that the Fed is behind them, for as far as the eye can see. That is only probably as true as inflation stays where it is. Okay. If you started seeing, because again, when people come out of this thing and the household savings rate is so high, they could go nuts with spending and travel and everything else. If they do that, then obviously you've got a tremendous amount of capital chasing a smaller group. There's not as many restaurants out there, so why wouldn't they raise prices? There's not as many cruise ships. There's not as many, hotels. There's not as many anything. Okay, so why wouldn't they try to jack people up on the price? And that could cause inflationary pressures. Okay, so that's what you got to be concerned about when you're loaning money to people for 1% interest. I mean, you're giving the government a 10-year loan, and say you give them $1 million. So you loan them $1 million, and corporations' yields are very low as well. But if you loan them $1 million, they owe you less than 10 grand a year while they hold on to your $1 million. Okay. Now, again, with a 10-year duration, if interest rates move 1%, your principal goes down 10%. If you don't understand how duration affects the price of a bond, again, email us and we're more than happy to go through the details for you. But duration is a big thing when you're buying bonds, because that gives you an idea of what the sensitivity is of your what? Of your debt instrument if the interest rates rise. So for an example, if you have a 30-year what? Instrument, that's a 30-year duration, right? And that means it's ballpark. If interest rates rise 1%, your principal can drop 30%. And all you're getting is a couple percent interest. And if interest rates change 1%, you could get hit for 30% of your principal. That sounds like lunacy. And that's why Jamie Dimon was saying he would not touch 10-year treasuries with a 10-foot pole. Okay. So having said that, again, if rates go to zero and negative, you could buy these bonds as long as you can see. But here's the deal. This is the TLT 20-year treasury. Our belief, that was a blow off top at 180. That's a blow off top. Look at it. Come on. This is a 20-year graph. Interest rates go way down, boom. That's because of the crash of 08. Then they go back up, right? Then we have another mini drop, so they drop again. Then we start getting growth, they go back up. Then we got choppy in 2016, 2015. They go down again. Then we got growth in 2017, 2018, 2019. They go back up again. Then we got a crash. And during the crash, what happens? They drop rates ridiculously low, okay? And now things are getting better, so rates are starting to what? Go back up. And that's why this thing's coming down. So right now, that's what it looks like. And the RSI is still above 50, okay? So again, rates have been basically going down, or obviously, since 06. And the RSI has been above 50 pretty much the whole time through that period. And right now, it's still that way. Now, looking at it on a 5-year basis, again, this 155 area, these lows here are very important, right? 155 ballpark area. Because if it breaks that area, you're going to get a more substantial rise in yields. A lot of people think we're going to see 1.5 on the 10-year this year. If we have any kind of a return, if these stock markets are anywhere near predicting what type of activity we get when a vaccine is fully distributed, then obviously the likelihood of these rates not going up, I think, is quite low. At any rate, that's what it looks like there. And on a 1-year basis, you can see rates started to rise. You had you had the 180 blow off. Now, again, our view is that 180 is similar to when Volcker jumped the rates to 16%, meaning that was the absolute high on interest rates, and that was about 40 years ago. And now 40 years later, you're seeing the absolute low on interest rates. Boy, if interest rates go, if it goes higher than 180, then we really are turning into Japan, where we just print money, buy our own securities, print money, buy our own securities. Okay, but I don't know if that's really where you want to be. At any rate, so this stuff looks a little bit heavy right here. On the other hand, if we get a stock market correction, which some people are thinking is going to happen in the next 30 to 60 days, 90 days, then bottom line is this could have a rally back up a bit if we got a correction, because people would start buying these bonds just because they have to put their money someplace. All right, three areas that we looked at to get better yields. One is in emerging market debt. Now, this is emerging market government bonds. So this is, government bonds, but it's for the foreign nations. Again, look at that. I mean, this is what can happen in a bond market. Supposed to be a pretty conservative deal, right? Well, this is the volatility that can happen if things get hairy on things. That's going from 84 all the way back down to 60. That's 33%, right? 25 divided by 82, more like 30%. Okay, so there you go. And now it got back on the bicycle here at 72. And then it got back on the bicycle further when it got above 76, and it's been above the bicycle at 78. 78 is pretty much where I would say you don't want this thing going underneath. So if there's a double dip recession, it'll take out 78, and that'll be a problem. If it is going to be a situation where the stimulus is going to help all nations worldwide, then again, this is something to get a better, a more aggressive yield, over 4%, I believe, then this is something that people are using. Still hasn't taken out its 52-week high, so it's not extremely overbought or anything. So there could be value in emerging market debt. When you hear emerging market debt, this is one of the ways to play it. Okay, and then of course you'd want this thing using the blue line as a gauge. Staying above 79 would be nice. It's at 82. Okay, so that's an example of emerging market debt. The duration on that is about 8.4 years. So it's 8.4 years duration. All right, high yield is getting away with murder lately because people are so desperate for yield, they are plowing into anything that pays any yield. Cruise ships are selling debt. I mean, airlines are selling debt. I mean, everybody's selling debt, even though they have a very bad backdrop right now. So this thing here, again, high yield, you got to, you play with the fish, you play with the sharks, you get bit, right? But this thing went down about $1.20 off of $6, which is a 25% drop. But then it got back above its bicycle here at 560, and then again about 570. And right now you'd like it to stay above the blue line, and the blue line comes in at 576, and we're trading 596. So again, it still hasn't taken out its 52-week highs. And going back 20 years, it's had drops before. I mean, there's your 08. Talk about a nightmare. This is high yield. Goes from $6 all the way down to $4. That's a 33% drop. That's no joke either here. But you can see they learn from here. Get the money out there fast. Get the money out there fast. Tell everybody you're backing the financial system, and then they'll go back on the bike. A lot of these markets are called dealer markets, which means they go from one guy to another. And again, during a crash like this and this, the dealers aren't going to buy anything. What are they going to take their checkbook and put it into a bonfire? Of course not. They're going to do nothing, watch the investor burn, and then they're hoping the fire department in form of the Fed comes in and says, oh, we'll buy this junk for you. We'll stabilize this. And all of a sudden, what looks so bad comes back up because the fire department shows up. The fire department is the Federal Reserve printing money, or at least creating what they call facilities that allow them to buy this stuff and other stuff to stabilize markets. Okay. So basically, high yield is paying, I think, 4 or 5%. You have to check. But again, it's back on the bicycle pretty good. The RSI is back above 50. And if you're a believer the stock market has a big future to it, you would think that high yield might be okay. So a little bit of emerging market to pepper or spice up your portfolio. It's more risky, yes, but it also pays better. High yield, same story. And the good news about the high yield at Vanguard is that their expenses are much lower than other high yield funds. And that doesn't mean it has to, but it could mean that they can go out and buy less of an aggressive bond and still get a good yield on it because they don't have such a big expense being taken out of their purchases. So again, with lower expense ratios, it allows the manager a little bit more flexibility on picking and choosing bonds. And when you're dealing in high yield, believe me, that's a very important aspect is selection. Okay, So there you go. And that's another way to try to get some fixed income money. And that's high yield. Last one on this stuff is going to be called preferreds. And on preferreds, you are looking at, again, very much hit. So again, this is a 33% drop too. So, there's no joke when these things turn, they turn. But this also pays a healthy dividend and basically, or a healthy distribution. And basically you're looking at, still an ascending situation. And many preferreds are offered by the banks. So if you think the banks are in reasonable shape, then you would think that their preferreds might be okay as well. So again, all this stuff may generate questions. If it doesn't generate questions, optionprofessor.com or optionprofessor@gmail.com and shoot it out. And if we can give you what we believe to be a legitimate response, we'll try to help you with that. Again, our opinion and our observations as far as you doing anything, you have to make your own decision. You have to talk to your brokerage firm about suitability and your broker, and then you take it from there. Okay, what else is going on here? Yeah, okay, one last one is tax-free. Oh, by the way, the duration on that high yield is 3.4 years. That's not too much. But of course, duration is not the biggest aspect of high yield. It's the selection, meaning is the credit the guy's going to pay back. But keeping the duration on a short leash, in my opinion, is in our opinion, is not a bad idea. Okay, let's look at a tax-free because they've come back on the bicycle quite a bit as well. Now, this has a duration of about 6 years. And it pays over 2.5% distribution, tax-free, depending upon what state you're in and all this other stuff. You know what I mean? If you are not in a tax-free state, then you might have to pay income tax. This is not a tax thing. So talk to your tax man and find out exactly what it means to you. If you're in a tax-free state, then you got a double tax-free situation. That's not bad. But anyway, here you've got a large selection of longer-term tax-frees, and this thing again is paying 2.5% or better, and it has been getting back on its bicycle. Let's go back 20 years on it to give you a perspective. Yeah, it's up near the higher end that it's been in 20 years. And then you're, again, if rates were to pop a little bit, these things can get hit. And if they get hit, they come back down. And of course, if you're accumulating it, a lot of this stuff could be a decent idea for what they call dollar cost averaging. Put a little bit in on a fixed basis over time. And then as the market goes up and down, you get better NAV prices. And you're accumulating and accumulating. And it's all coming into you as far as the distributions, on the tax-free bonds. Coming in and you're increasing your tax-free income over time. And then you're peppering your purchases so that you can take advantage of the swings. That's what dollar cost averaging makes a lot of sense. If you don't do dollar cost averaging and you buy here, then you have to go through this whole drop and you got no money to spend. And then it finally comes back to where you are, but that's months and months of where you were underwater. Same thing here. So if you get in at a high price, that's why I was listening to John Bogle. He said, dollar cost averaging may not have much value, but under certain circumstances, like if you bought when he was born, which was 1929, he made a point that it took 15 years to get back to break even. So yeah, dollar cost averaging can be poo-pooed, but it also, under certain circumstances, can be the better way to go. Okay, so that's what we've got there on fixed income. And now I'm just going to go around the horn here in the last 10 minutes and just give you a little bit of ideas on what's going on with some of the different markets. Let's look at the US dollar, because the US dollar is a very big key. It got much weaker, which we brought to people's attention earlier this year. When it broke, I'll show you when it broke. We're looking at the 1-year graph. And it gave you a very nice sell signal up in the 100 area. The high on it was 103. So it's been downtrending for a long time. And we told people about this a long time ago. You see that? Downtrending since April. Why? Because they're printing a ton of money, and obviously that's devaluating the fiat currency, right? And they lowered interest rates. So you got to, we used to have a yield advantage. We got no yield advantage to speak of now. We got some, and that may help the dollar in the short run. But this thing here has been downtrending because we gave away our interest rate yield advantage, and we also started printing money like it was the LA Times. So there you go. Now, again, this is a negative looking market. I mean, the RSI is under 50 and the prices are downtrending, no doubt. Let's pull it. That's on the 1 year. Look at the 20 year. Let's see what's going on there. Yeah, it busted all long-term averages too. So when people are saying they're negative on the dollar, but again, they were negative on the dollar here when it went to 88, and then it went right back to 104. So, you know, you have to be somewhat careful, but right now it does look negative, and certainly our feeling is 88 and 90 is the last stop. After that, you're going to go down, and maybe you'll bounce off 85 because these are the former highs here. So the real big support on the US dollar, in our opinion, in our view, is between 80 and 90. This is the area. Will it get in there? It very well might, because obviously we're stimulating, we're printing, we're keeping rates low. So it very well might. But again, and of course, if we have a big economic recovery, other currencies may do quite well. So let's take a look. And this is one that we were very positive on when it broke above 100 and then 110. And we'll show you this. This is called the euro. And they just passed a $2.2 trillion budget. So they got plenty of money over there they're throwing around. All right. And let's see if we go here to the 20 year. And there you go. That's above 50 and it looks like it's breaking out. So it looks, looks very strong. It looks like the inverse to the dollar, right? So again, once it got above 110, that was our first, see the red line, that was our first hit. Then above 115 is the add spot. And right now you're enjoying the ride, okay? Our RSI looks good, but again, a little bit overbought, a little bit. Let's take a look at the 1 year. Yeah, a little bit overbought on the short run. You're 10 points above the, not 10 points above, you're about 20 points above, looks like. 3 points above. Anyway, it's a little bit extended, nothing to write home about. And again, the path for the dollar does look like it's lower. It's just that when you get this unanimity of opinion and you get everyone on one side of a market, we saw that with gold at 2100, that's not a great time to be loading the wagon. Although this is not anywhere near as extended as the gold. Aussie dollar has been looking real good. Something we've been telling people, been positive on. Let's see if I can get the Australian dollar in here. Yeah, you see, once it got above 70, it was a good deal. And going back 20 years, it's got a lot of room to run. Used to be 100 to the dollar. So, this thing's got a lot of real estate, the Australian dollar. And there's a little bit of a gold play there too. So I don't know, if you think you're bullish on gold, you think it's going to stay above 70, then obviously Australian dollar could be one to keep an eye on. British pound, only interesting now because it looks like they're going to get something done. And we started getting positive at 130. And so basically, I think it's in the 134, 135 area. Let's take a look. 134. This is a neighborhood where it's having some trouble because it's the former highs right there. But you can see, the Australian dollar and the British pound, they might be the ones to keep an eye on here in 2021 because there's a lot of real estate up here. And, if they get this euro thing done and, they get this vaccine out there and, they're not printing nearly as much money, I don't think, as we are. And where's the RSI on this baby? Yeah, see, it's above 50. So keep an eye on those two currencies this year because I think there could be something going on. All right, I got to jump fast here because I'd like to get into the gold, silver, and Bitcoin. Let's go. And then I got to sign off. Gold. Our view on gold, very simple. That high point there could be a blow off, and we thought it was because you see how far away it was from the averages. Okay, but the get-in point here was 1400. That was the get-in point because that's when you broke above these two here. So that's your get-out point. You came back and tested it. You blew off here. Now, we took a little bit of a bite here at 1775 because it was hitting the short-term average, and we got a nice bounce. So right now, your line in the sand should be 1775, okay? If it breaks underneath there, then it opens up these longer-term averages as well, okay? Right now, that's your line in the sand. let's take a look. And the same thing with GDX and all that stuff. So I don't have time to go through everything. If you have interest in that stuff, shoot us an email, optionprofessor@gmail.com, and we can give you an idea of what we're following. Okay, let's turn to the silver. That blew off to 30 bucks, was what we said. We said breakout point was 19.20, which was a great time. You see, breakout at 20, so you get long. Goes up to 30, that's a blow off. Why? Because look how far it away from the averages. Now it's consolidating, right? Didn't come all the way down to 21, which I thought went down to 22. So this pullback area here is really the line in the sand, 22 even. I thought it might get down here, but it didn't do it. But hey, 22 is not bad. And right now it's at 26. So there's your line in the sand. You want to be bullish on silver, but you don't want it under 22. If it gets under 22, it opens up 20 and it opens up 1750. Blows above 30, it opens up all this stuff up here. And again, this, in our view, is much better potential than gold. Platinum is another one that has good potential as well. All right, let's look at Bitcoin here because people are into that, and we've obviously talked to people about it. But rather than look at Bitcoin, I'm going to look at the proxy for Bitcoin, okay? And that's GBTC. That's what we use as a proxy for Bitcoin. And it's gone from $5 to $27 or something like that. So it's at 30, okay. So it's even more. Now let's go back and give it a shorter term graph and we show you what we're talking about. Okay, this thing got positive once it broke above 14, right? Once above 14. Now, there's your moving average, there's the price. I mean, is it gonna pull one of these deals? It very well may. But again, you know, this is a tough place to start buying Bitcoin. If anything, you develop a dollar cost average plan where you buy a little here and then you do it over time, and hopefully you'll get some more actions like this. But again, there's a lot of players in there, Square, PayPal, you know, Mass Mutual Life Insurance. So this thing is getting more and more popular. And unlike fiat currency, it has a more limited supply. Personally, I'm not on board 100%, you know, because the volatility could be a little bit great for some people's money. But again, you know, accumulating it over time makes a lot of sense. You start buying it here and circumstances change, you know, it can be a very rough ride if the news changes. But again, starting an accumulation thing over time might not be the worst thing to do on Bitcoin. So again, but that puts in perspective how far away we are from the averages. And you can see once we got like there last time, it couldn't sustain the price. But this is, you know, this has got more people involved than they did there, I think. And our opinion is that this is a reasonable way to play it because it's traded on the exchange. Why? Because there's a good size volume, and you know, at least you got something you could look up, you know, as a quote, and you could do something on a regulated exchange. Okay, so we went through obviously an awful lot of information today. What we do is invite you to get our weekly updates every week in 2021, and also tell friends and associates who would like to get a update on all the stuff that we watch free of charge. All you got to do is go to option, O-P-T-I-O-N, professor, P-R-O-F-E-S-S-O-R.com, put in your email, and then each week we shoot out to you the update. And then, of course, if you have questions on anything, you simply email optionprofessor@gmail.com. And if we can assist you in finding information, that would be fine. Again, we're not specifically recommending to anybody simply because we don't know the people and we don't know your backgrounds. We don't know your financial circumstances. So it would be lunacy to recommend to people you never met. So the bottom line is that type of stuff, the investor makes his own decision, and the brokerage firm and the broker have to discuss suitability and appropriateness of any investment to the investor. And that's not part of our game. Okay, all right, guys, it's good. It's top of the hour. I think we covered enough for one day. Happy New Year coming up on Friday. Let's enjoy those bowl games, and let's have a little bit of fun. And again, until we talk to you next, this is optionprofessor.com, and we wish you all the best of health and best of trading in 2021. We'll talk to you down the road, and don't forget to send your emails in and your questions. We'd be more than happy to try to help you. Back to David.
All right. Thanks. Covered a lot of good info today. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory or app. And you can also go to TimingResearch.com to get access to the recordings of any of the past shows or events, as well as this one as soon as I can get it posted in the next few minutes. So, all right, thanks everyone.